Hi and welcome everyone for the next presentation. My name is Daniel Torsson, analyst at ABG, covering IT and technology companies. And with us for this presentation we have Proact and the CEO Jonas Hasselberg. So I let you go ahead with the company presentation, and I have a couple of questions in the end.
Fantastic. Thank you. And thanks everyone. Good morning. Thank you for having us. So my name is Jonas Hasselberg. I'm the CEO of Proact since a little bit more than 4 years. I'll talk a little bit about the market, the company, of course, some of the progress we made, and we'll touch on some of the financial numbers. And like you said, Daniel, we'll leave some room for questions at the end. So for those of you who don't know us, we are 29 years old. We're an IT solution provider based out of Stockholm, but we operate out of 13 countries in Europe. We have a customer base of large and medium-sized enterprises, public and private across our regions. We're turning over about 4.3 billion Swedish kronor on a yearly basis, and we're employing 1,200, a little bit more than 1,200 people across these countries. Our employees are highly skilled, very technical and skilled experts in the area of IT and IT solutions. I'll just very high level talk a little bit about where the market is going, and this won't be news to most of you, but there's a couple of drivers that are important for Proact in terms of our business and our growth. Number one is that all our customers are going through some sort of digital transformation. A lot of it is driven, of course, by improving their business. Could be simple things like better decision making by getting access to data, automating processes, improving production, putting a lot of AI or innovation tools into work of their business. Everybody wants it to be sustainable. Of course, sustainability is rapidly increasing. Many of you know that IT and data centers are consuming large amounts of electricity. So a lot of drivers is just to be more efficient from that perspective as well. But obviously, ultimately, business innovation through IT. And that's the business driver for us. There's a technology driver in our industry, which is driven by what's called cloud, but cloud needs a little bit of a clarification. We use terminology like hybrid cloud or multi-cloud. And the point here is cloud is not as simple as just going to the Microsoft cloud or the Google cloud. Most of our customers are living in a mixed world. They want to use Google or Microsoft or Amazon for large-scale general purpose things, but at the same time they may have applications and legacy systems that are very old that cannot move easily, so they continue to run a lot of their IT in their own data centers. They may have regulatory requirements that data needs to be within their own jurisdiction, or they want to have data in their own control. So everybody's going to live for quite some time in a world where they have IT infrastructure in their own ownership or in their own premises. They're going to leverage the large public cloud providers like Google and Microsoft and Amazon, and they're going to use companies like ourselves to make all of this actually work together, and data and application to be transparent and flowing. So the technology trend is very important for us. Some may think that it's becoming easier and easier for our customers. Fortunately for us, it's the other way around. The world becomes more and more complex from a technology perspective. The innovation pace is incredibly high. The complexity of managing old legacy infrastructure, regulations and business requirements with the speed of innovation that we see in technology is difficult for our customers. They need partners like ourselves to help them navigate this. The third trend, which is maybe the less positive one, is obviously the ever-increasing threat of cyber attacks and the need of having a high degree of cyber protection for our customers. Another opportunity for us, but obviously not necessarily a positive thing. So these are the three high-level macro trends that drive our strategy, but also drive our growth opportunity. So what we do, we are a specialist. We are not a general purpose provider. We are very much geared about helping our customers get value out of all their data. That still means that we deliver IT solutions, and we would do basic reselling of infrastructure, so servers, storage solutions, networking equipment. But more and more, of course, we deliver IT infrastructure as part of a service. So the customers buy it as a service from Proact. We deliver hardware and software, servicing them, deliver them as a service. We deliver technical support and more, of course, consulting services, so helping our customers navigate the ever-increasing complexity of IT. And all of that around a couple of value propositions, helping our customers design their strategies, helping them store their data in a secure way, helping them get access to that data in an effective way, so networking and connectivity, protecting, as I touched on already, so the securing of the data, and ultimately getting the value out of that data. So we have a couple of very crisp value propositions. I won't go through this busy slide in detail, but we have a range of offerings that cover this whole area. Everything from storage solutions, networking solutions, disaster recovery, server solutions, artificial intelligence platforms, cybersecurity and protection solutions. We have a very complete portfolio, and where we allow our customers to select whether they want to own the equipment and run it on their own in their own environments, or if they want to buy it from us as a service. So we're pretty agnostic to how customers consume their IT. We want to deliver the value to them and fit their particular strategies. And here's another way of depicting this. So this environment is becoming more and more clear. I'll give you a pretty crisp example of my former employer. I used to work at a company called Telia here in Sweden. Some of you may know them, a big telco. Telia has an interesting range of IT solutions. They have thousands of applications, of course. It's a large company, complex operations. Some of those IT systems ranging from the year of 1967, so old mainframe solutions on one end, and obviously they're using public cloud and super modern IT on the other end, you know, the latest and greatest, if you will, from companies like Amazon and Microsoft. And managing that whole environment is a non-trivial exercise, even for a large company like Telia, and they're therefore needing to really be able to work all the different aspects of their IT infrastructure and get the best value out of every investment. So we deliver this from 4 different delivery hubs. So we have service delivery operations in 4 main hubs: Sweden, UK, Netherlands, and Germany. And hereby we can then deliver packaged and standardized managed services to all our markets across Europe. And this is a good way for us to get scale, efficiency, and also be able to standardize the way we deliver our service to all our customers. And one thing we haven't spoken about in large detail is our security offerings. This is, as I mentioned here in the beginning, an increasing demand, of course, and frankly, quite difficult for our customers to manage themselves. Obviously, cyber attacks don't rest over weekends. They don't rest over non-working hours, over the nights. This requires 24/7, every day of the week attention. And it's relatively difficult to both identify attacks, but also, of course, remedy or respond to an attack. So we run security operations centers out of our UK presence that cover all of Europe. So we have very skilled people coming out of with frankly specific cyber security training out of university that run out of our operations center. So we can then help our customers to both identify security threats and respond to them on a 24/7 coverage basis. And this is a very good and positive strength of ours, and something that is frankly quite difficult for enterprise customers to manage themselves. So something we may not have spoken about as much as we should have, but one of the key assets and key expertise areas of Proact. We have a strategy of growing, and we have a strategy of broadening our offerings to our customers. We accelerate a lot of that through acquisitions. So over the past 3 years, we've acquired 5 companies across Europe, all of which are both actually gaining some market share for us, but also bringing new skills and new offerings into the company. The first one was a company in the Netherlands called Finwire, very strong in providing managed IT infrastructure and managed workplace solutions to enterprise customers based on Microsoft. So a high degree of cloud-based skills and expertise. We acquired a company in the UK called Cetus, based out of Manchester, also very good in hybrid cloud solutions. So really able to help customers with that hybrid environments where things need to work together in a transparent and integrated way. Here in Stockholm, about 2 years ago, a company called Conoa, super skilled, probably among the best in Europe around what's called cloud native application development. So they're helping customers develop platforms for rapid application development. And we have customers that traditionally would spend several months on updating their applications and bring this down to days or weeks with these types of platforms. They're speeding up the innovation pace drastically by just using modern and cloud-native application development platforms. And then in Germany, exactly a year ago, a company out of Dortmund called AHD, also a managed services provider of enterprise-grade solutions. And then last but definitely not least, earlier this summer, or earlier summer of this year, I should say, a company also in Germany called Sepago, a highly skilled consulting company with focus on Microsoft and workplace solutions. With the two latest companies also not only do they bring great expertise, but also give us a very good presence in the German market. It's obviously one, if not the largest IT market in Europe. Highly regionalized, it's important to be present across all the geographies, all the regions of Germany, and now we have a good presence and quite a footprint in the German market. And then these numbers are getting a little bit old because it's from our third quarter. We'll announce the fourth quarter, of course, here in the beginning of next year, but tremendous growth during this year. We're growing with about 30% year to date and 36% in the individual quarter of Q3, partly through the acquisitions, but a very, very strong organic growth as well, which has been fantastic. Partly because there's huge demand in the marketplace, which we've talked about a lot. Obviously, we're coming out of COVID as well, and we see a much higher pace in the marketplace than we saw during the years of pandemic. We're also growing the contract value of cloud services. So for those of you who follow us know that we talk about something we call total contract value, or TCV. It's the value of new contracts that we've signed up in the quarter for cloud services. We had a very strong quarter in Q3 with new contract value of 158 million. And good growth thereby in our services. We're, since a couple of quarters back, communicating a little bit more clearly what we call recurring revenues. So revenues that are under contract, which is obviously much more comfortable for me and everybody else, that we know that we have customers that are paying on a monthly basis, not on a transactional basis. Good growth also in what we then call ARR, or annualized recurring revenue. We're now just short of $1.5 billion in terms of yearly revenue that are under contract from our customers, which is very positive. And then last but not least, for those of you who remember, about a year ago we came out with a profit warning because the semiconductor deliveries were impacting our industry. And even though we've been closing deals at a good pace of Q4 of last year, we couldn't deliver them on time, and things slipped into this calendar year. We've now seen the semiconductor situation during this normalizing. We had some backlog throughout the first quarters of the year, but we've also been clear and seen that the situation is improving here during the second half of this year and continue to improve. So we're pretty much on normal delivery times now for equipment and semiconductor, which is great. So that problem, if I may put it that way, seems to be behind us finally. So good third quarter and overall a good traction in the market coming off of the pandemic, with both organic growth as well as acquired growth for the company. And that was it, Daniel. Quick and hopefully concise.
Absolutely, that's great, Jonas. I have a first question on the semiconductor situation.
Yep.
You have a strong order backlog that you are delivering on, so sales growth is going to look nicely ahead. It was strong growth in the past quarters as well. How is underlying new order intake progressing in Q3 and Q4? And what do you see?
No, we've seen a good activity in the marketplace, so which is positive. So it's not only that we deliver backlog, we also see good activity in our customers for closing new deals. So it's been a good market all the way up to Q3, and we'll continue to see a good market. Obviously, we don't give any forecasts, as you guys know, but it's been a good good activity in the marketplace throughout the year.
Yeah. And to understand geographically a bit, your largest market are the Nordics, UK, Germany, Netherlands. Do you see any change in customer behavior throughout 2022, or do you have the same growth pace in all of the regions?
It's roughly the same growth pace. Some have been, and we have slightly different customer demographics in our different regions. So that's visible. Sweden, typically very large enterprise customers. Netherlands, to contrast, a little bit more mid-sized customers. So in Sweden, we would still have quite a bit of systems business or traditional reselling, whereas Netherlands is way ahead in terms of cloud and managed services. But good traction and growth in all our markets and very positive momentum, I'd say.
And looking ahead a little bit, in a slower growth or lower investment period for corporates, is that mainly going to hurt your systems business or your service business? Or how should we think about kind of next year, for example?
And I think so this is a little bit of a tricky one, I think, and I won't be able to give a super straight answer. I'll actually give a double-edged answer, just to cover all my bases. Clearly, the recession and inflation is a risk for everyone, including ourselves. I think we'll see if there is a negative impact. We'll definitely see it impacting systems and possibly our consulting business. If I reflect back to the beginning of COVID, where we thought the consulting business and the systems business were going to get hit most, we didn't see it. So that's the flip side of this coin, that we do see a lot of customers continue investing in IT and transformation to become more efficient and come out stronger out of a recession. So the possible upside is that our customers continue investing in their transformation so that they are stronger after the recession. But if something happens on a negative basis, I think systems business is obviously the more volatile and sensitive. Cloud services, support services are under contract. We've had a very strong year this year in terms of closing new cloud contracts, so we should be able to monetize on that during next year.
I see. Given your value proposition, do you think that you help your customers being more efficient or helping them to grow their business? Because I guess that lots of the customers and corporates in Europe here next year, they're going to aim to become more efficient in the market that is slowing. Do you help them with that, or rather drive growth for them? Or
both, and I think historically it's been more on innovation and growth, but it's not unrealistic that as we look into next year, there will be a lot of work around being more efficient. Both are, of course, good business outcomes for our customers, and ultimately, that's the most important thing for us. We don't do IT for the sake of IT. We do IT with our customers to help them be better. Innovation or efficiency, both are good.
How is the relation for your cloud business? You mentioned hybrid cloud and explained why you are not just a reseller of the public cloud space, obviously. But we see that the public cloud companies in the US, the Microsoft, Amazon, Google, etc., they see a slowdown in cloud revenues now, which is probably coming from the public cloud market. And are you being affected by that to any mean, or?
Not really. So our value proposition on the public cloud is not reselling licenses. We do a lot more on top of the public cloud. So I think the analogy here is that when we sell a piece of equipment, so our traditional historical business has been reselling of hardware and software, typically American vendors, and then we add value in terms of consulting, managing or operating the equipment, technical support. So our primary value add is not the reselling, it's the services we add on top. And obviously we look at the public cloud in the same way. Microsoft or Google or Amazon provide let's say, a general purpose platform, and then we help the customers get value out of it by adding services on top of it, managing it for them, making sure this whole multi-cloud environment works, so data is flowing efficiently, it's secure, the users can get access to it. So our value add is not the reselling, it's our services on top, and there's plenty to do there, even if their sales growth is coming down. They have increased pricing, and if you read external analysts, a lot of people expect that license costs for public cloud will increase by 30% next year. Obviously, that's something that may even have our customers come back to us a little bit and say, hey, can you guys do this more efficient? Public cloud is not the cheapest way of doing things, some people may think, but it isn't. It may provide you very high, modern, highly innovative technology, but it's not always the cheapest. And customers are then trying to balance price performance will have to think hard.
I see. Then regarding the consulting business, do you think you will be able to mitigate potential salary inflation next year with price increases for that services on a standalone basis?
That's definitely our ambition, and we've been working on that since beginning of the year. We saw the risk of inflation already in the beginning of the year, and obviously the actual inflations here during the middle and second half of the year. So we've been working on increasing hourly rates for our consultants. All our reselling business, all price increases are flowing through. So we take quite a little hit of that. And then all our contracted business, we've been upping the pricing on throughout the year, both new contracts as well as existing contracts. So I think we've been proactive, and we've been trying to mitigate inflation as much as we can. There are contracts that are less easy to change, but I think we should be in good shape.
Yeah. When we look at the customer base for Proact, how is the split between public customers and private customers, and how do you expect them to develop in next year? I guess that the public side is going to be more stable, where you can raise prices due to the contracts, CPI-linked price increases, while private sector may be a little bit more difficult to negotiate with, or?
It goes both ways, unfortunately. But I think our public sector is roughly a quarter of our business. It goes a little bit up and down, and it's usually stable. And maybe in times of decline and recession, public sector is investing, which could be good. We see contract-wise public sector sometimes more tough on the index-regulated contracts, and sometimes more open. I don't think you're going to see necessarily a segment-based opportunity there. It's going to be other things that drive whether we can manage price increases or not.
Okay. Will you be helped by contractual price increases from kind of 1st of January 2023, which is quite common in the industry here, with the public sector, for example? Would that help you get some growth next year, basically? Or?
I mean, I think part of the growth will be inflation-driven, for sure. Yeah. Absolutely. And then there will be volume growth as well. So I think from that regard, from a pure top-line perspective, the inflation is helping us. But we also need to manage our costs, of course, to have it flow all the way down to bottom line.
Yeah. And
I think January 1st is a magic date from that regard, if that's what you're asking. No.
Yeah. And in terms of acquisitions, you mentioned the 5 latest here. It has been 1 or 2 every year. Is that what we should expect in the future as well from Proact?
I think that's a good pace for us. The way we do acquisitions is that we're quite picky. We want them to have a very clear value proposition that fits our portfolio, and we integrate them into our operations. So there's a lot of work in our due diligence process around culture and just pure company fit. And that also means that the integration actually takes time and effort. So we can manage roughly 2 acquisitions and integrations per year, and particularly if we rotate them around our regions. So we're quite decentralized in operations. So now Germany have their work cut out for them, 2 acquisitions in 6 months. But it's been quite some time since we did anything in the UK, Netherlands, and Nordics. So plenty of opportunity there.
And regarding the type of companies you're trying to acquire, historically, before you came to the company, Proact tried to acquire hardware resellers and transform them into service businesses, while now the strategy seems more to buy consulting or service-oriented businesses and then add some hardware reselling on it. Is that the way forward as well in your view? Or?
It is. I mean, clearly the service opportunity is much bigger for us, and the market of services is growing 10% per year at least, whereas the traditional reselling business is maybe a few percent, partly then driven by inflation, as mentioned. So the opportunity is bigger on the services side. So we're going to look for companies that are really good in the area of Microsoft Public Cloud. We're going to look for companies that are good in security, possibly networking. It'll be a mix of consulting skills or cloud services offerings. Yeah. That's where we're going to be focusing on.
Yeah. Then the final question on the margin target. You have a target to reach 8% EBITDA margin. You haven't been there for many, many years, so it seems to be an opportunistic target. What is really the key drivers to get you there in a few years' time?
I think we were hit negatively by the pandemic, so maybe the time schedule is a little bit further out than it should have been otherwise. But there are 2 easy things to say, not as easy thing to do necessarily. Scale is one of them, so continue grow our services business. And here I think we're doing quite well now, in particular this year. And then we have our own internal efficiencies. We still have work to standardize our service delivery and increase the level of automation and therefore become more efficient. But we should be able, if the world is somewhat stable going forward, which of course it's not showing any trends of that yet, but if it's somewhat stable going forward, we should be able to become more and more efficient over year by year.
And how important is acquisitions to reach the target? Is it necessary, or can you get there without future acquisitions?
It'll help us get there quicker, but I don't think it's necessary. But obviously, it drives scale quicker. It's a way to accelerate what we anyway do.
Excellent. That was it from our side. Thank you very much, Jonas, and presenting Proact.
Thank you very much. Thanks.